It's a magnificent week of earnings. Alphabet, Microsoft, Amazon, Meta, and Apple all reporting this week. So what's the sentiment looking like in the options market ahead of these key reports? Well, joining us now is Amy Wu Silverman from RBC Capital Markets. Amy Wu, it's great to have you on. I do want to start right there. I mean, we know options trading has been having its moment again over the past year or so. What is being indicated ahead of these reports, and specifically when it comes to the potential size of moves we could see in either direction around these mega cap tech names?
Yeah, it's a great question. It's such a crucial week that we have ahead. And I think by far the most interesting thing that options are saying is that there's going to be a whole lot of nothing in terms of moves, the implied moves. So what the options are pricing in for these mega cap tech earnings is pretty low compared to what we historically know these options move. And what I think is really interesting about that, Morgan, is if you actually went and looked at Tesla and Netflix last week, they said pretty much the same thing. And we got pretty substantial moves for both those stocks last week. And we think we may see that again. We think those option prices are probably too low heading into this crucial week.
That's really interesting. I mean, why do you think we're seeing that? Is that just the fact that it's basically become these stocks and nothing else in the market, to put it very dramatically? And so people are maybe perhaps a little lackadaisical going into these reports, or is it something else?
No, I think lackadaisical is a good way to describe it, or perhaps maybe even complacent. You know, I think the sentiment when you dig in even deeper and you look at that call wing and that put wing, so the downside and that upside, we're far less exuberant now than we were last year when the AI frenzy began. But to some degree, that's because everyone's already jumped into the pool. So there is a big difference in terms of positioning. With that being said, you know, historically, this tends to be the time in earnings season where we get the biggest move in earnings. The first few weeks are the time to own volatility, yet they continue to be very cheap, in particular with how positioned people are to be long these stocks.
Amy, here's what I can't figure out looking at this and the really interesting analysis that you're bringing. The market's at all-time highs. We've got stretched valuations. We're going from Q4 to Q1, where I would think there are questions about whether there was demand pulled forward or what happened. Is it common for there to be an expectation of such calm in this sort of a situation?
So I would say that this is definitely, compared to other earnings seasons heading in, more complacent. The implied move ratios that we look at are cheaper than they are historically heading into other earnings seasons. And I think that could be a mistake on the part of investors. In particular, I think it's become just simply this flight to safety trade. You know, we had the brief fling with small caps and value starting in November. The market seemed to go back to its type of mega cap tech and Mag 7. But the question is, again, with the positioning where it is and that downside relatively inexpensive, does it make sense this week to do some sort of hedging given how well these stocks have done?
Okay, so based on the relationships that you've seen up to this point, should you be correct and should volatility be higher than the options market is expecting, what sort of ripple effects would you expect to see either on smaller stocks or on sectors as a whole?
Yeah, you know, in some ways, it's really straightforward, just in the sense that these are just the biggest weights. So, you know, when you have four of the biggest weights in all of the Qs, all of the S&Ps, you know, perhaps don't do as well as expectations, and you just automatically get that ripple effect into the ETFs. Now, it's interesting, though, because it seems like there has been this trade-off between small value versus these large caps. And so to some degree, it could actually be a benefit to the others. But we'll see. I think it still is the case that if tech goes, the market goes.
So if there's an opportunity to hedge coming into these reports and it's inexpensive versus what we've seen in the past, how would you do it?
So that's something we've been talking about with clients quite actively this week, in particular clients who, you know, felt the FOMO last year and now are pretty heavily long in these stocks. We think that just the weekly puts or put spreads are quite attractive from a payout perspective in an Apple or an Amazon or a Meta, where, again, if you actually look at every single stock that's reporting this week, Meta, for example, is actually the cheapest implied move among all of them, which is just really staggering.
Yeah, interesting. Amy Wu Silverman, thank you.